Hello, everyone. Can you hear me, Yuran?
Yes.
Great. So today I'm gonna cover something that is not required for quiz and exams. So feel free to not watch this video if you are busy with other things. But I think it's necessary to be covered, at least as an option for you to know what's going on. And it might be useful for your future other work. So today's agenda, we will first cover the optional section in chapter 7, estimate CAPM model using real data, which requires more advanced Excel skills and not only calculator. And secondly, I'm gonna cover a chapter 6 Excel example. So because in class, I only ask you to like hand calculate those standard deviation or the weight for portfolios. But in real world, there is much more data that you should work on most of the time. So in that case, you might need Excel at least or some other programming languages. So I will cover one example in Excel. And then I will go back to what we just covered in the first part, estimate CAPM using Excel. So I classify it as chapter 7 Excel example. It's basically about using real data and to estimate CAPM model in Excel. So let's get started. This is the section on estimate the CAPM. So in this part, I will not have practice questions because it's not tested, and I will show you an Excel example later in the third part. Let's think about the CAPM model. Just a recap. Let me write it down here. The CAPM model is expected individual stock return equals to risk-free rate plus beta of individual stock return times the market risk premium. So in the real world, beta is very important to know. And beta is the one that we are trying to estimate most of the time. Because as I said, for individual stocks, you use beta to estimate the systematic risk or to estimate the risk rather than the standard deviation. That's why like beta is usually the focus when you think about estimate CAPM in the real life. And when people goes to the real data, there will be a lot of nuanced details and hard to choose, which causes noise and error. And there is some difficulties to balance the benefit and like downsides. So for example, time window. Okay, so for example, if you want to estimate the data, what kind of time range do you use or should you use? If you use too wide, say from 1920 to today, you have a lot of data, but it might not reflect the most recent features of the stock. And or if you use too narrow, for example, you just use previous 1 year return. Yeah, it's capturing more current status or current risk level of the stock, but you don't have a lot of data. And as maybe you have learned in your statistics class, usually the more data, the better your estimate. It means less error. So there is always a trade-off between the most data as like more data to use versus like what's the time frame you want to use for estimating beta. And another thing is, as I said, how do you proxy for the market? In the CAPM model, again, the assumption is the market portfolio is the best, the perfect, the most well-diversified portfolio in the whole world, including all the markets. But that's very hard to do because many assets are not measurable or not tradable. So you simply cannot, or you simply cannot get the data on those markets. So most of time, people use S&P 500 in industry to approximate for this part, the expected market return. And in academia, we use CRISP. CRISP is a data set that includes all the publicly traded firms. So we use value weighted average, as we learned very early in this semester, the market capitalization weighted average to calculate the market portfolio using all the stocks. So, but still, as I said, either CRISP or the S&P 500 are assuming the market portfolio is just the stock market. However, it's still different from the absolute definition in CAPM world. The market portfolio should be much wider. Okay, but people uses the proxies in stock market for some reason, because usually when we measure beta, people want to know the exposure to the stock market variation, because you're always interested in estimate the stock return, individual stock risk level, or individual stock beta. So it makes sense to some extent that you use the stock market as the proxy for the market portfolio. And when you compute, the third one is when you compute the total returns, sometimes you need to include dividend. As we talked earlier, like the return equals to T plus 1 plus dividend plus 1 minus PT. So it has both parts. One is the capital gain part, one is dividend yield part. So dividend is also necessary to be adjusted. And there are many more details to think about, like monthly versus daily versus yearly. So which one you should use. That's a lot to think about. And it depends on your specific scenario, okay? Then, after you estimate the beta, say you get a beta from your data, we call it beta hat, it's an estimate. It's never perfect. And it, as we said earlier, one problem with CAPM is that it assumes constant, the unique beta. But in the real world, the risk level of individual stock might change along the time because of like different aggregate level economic shocks, or maybe firm specific idiosyncratic shock. So the beta is not stationary. Then if you just use one big data sample to estimate it, it might not be good. So, and also sometimes when you observe the stock return, it might be very noisy. By noisy, I mean, for example, if you think about GameStop or Bitcoin, the return might be super volatile. It might be because of very temporary events going on, drives the prices going up and down very crazily. But if you use the very noisy and very volatile sample to estimate beta, your beta might be very crazy. Like, for example, if you use most recent 1 year to estimate beta versus using like previous 2 years to estimate beta, your result might be very different. But it's very hard to argue that the firm changes its risk profile within 1 year, like very short time. So in this case, the noisy data will lead to very biased or not accurate estimate of beta. In this case, say if you get extremely high or low estimate for the beta, they might be due to measurement error. It's similar to noisy, like measurement error, usually because of the noisy data, like data is not very good. Then if you get too much, if your error is very high, your estimation of beta will not be trustworthy. What you can do is two ways. This is the first one. You can adjust the beta as the weighted average between your estimate. The sample beta is the beta height that you estimate, and 1. Because usually the average beta all over all the securities is gonna be similar to the market. Think about that, because market includes all the securities. And if you calculate the individual data for each security and average everything, it should be similar to the market one. And using the market beta as a benchmark, if you weight average between your estimate beta and the market benchmark, it will give you a sense, or it might adjust or decrease your measurement error, hypothetically, because it's based on the assumption that you trust that the market is a good benchmark. And of course, this 2/3 or 1/3, how to choose that, that's also very hard to choose. It might need a lot of some institutional knowledge, or may need some special assumptions. But that's one idea, that you can balance it between your estimate from sample and the market as a benchmark. That's the first way to do that. And the second one is you can use the average beta is also still the sample beta, and use the industry benchmark rather than using the market one. Because sometimes, for example, if you estimate Google or Apple, it's from technology industry, and there are many other firms going on in this industry, and the industry level beta will reflect the common industry risk that will affect all the firms in the same industry. So rather than using market, industry might be a better benchmark to use, because like market includes too many industries and it's the aggregate between all the industries. But sometimes the market does not really reflect the risk level of industry. So if you use industry benchmark, it might be more relevant to your specific firm. And again, how to weight average, like 2/3 or 1/4, that's an art, or that's a hard thing to choose. Depends on your specific scenarios, or depend on your assumptions. But again, the key takeaway is that your data might be very noisy and your beta might not be trustworthy. Then how do you do that? You might want to adjust your estimate with some benchmark, either market or industry. Any questions?
Yes. So
Sure.
how do you know, like, if the beta needs to be adjusted?
Usually it's either very high or very low. So if you observe some stock beta is like 100, for example, that's quite high. That's not very common to see, or it's just a close to 0. But usually, 0 is risk-free assets, and stocks cannot be risk-free. So if you estimate a stock has 0 beta, that's sometimes problematic.
Okay, I see.
That's two scenarios. Or you can do rolling window using the data. For example, you use the previous 1 year and previous 2 years, previous 3 years. Like if you change your data sample and you find the data is changing a lot according to the sample, it might mean the data is very noisy, because you get inconsistent results, too inconsistent results over time. And then you might feel worried that, oh, my beta might not be very well estimated.
Okay, I see. Thank you.
If you have questions, you can stop me, like just interrupt me, that's fine. Okay, I cannot see your face, so.
Okay.
Sometimes, as I said, when you choose the data, it's a depends. Sometimes some people use daily data, for example, here. And sometimes people use monthly data. Sometimes people use yearly data. So it depends on your specific question and your goal. But usually the lower frequency, low frequency means okay, low frequency usually, for example, if you think daily data is high frequency, then low frequency is usually annual data. So the higher the frequency, the shorter the return, the time range of the return will be. And as we said earlier, in the high frequency trading or algorithmic trading, they even might use millisecond data, like millisecond return to calculate something. So the higher frequency, the more frequent the data point is. And at the same time, the higher frequency, the more noise. It's easier to think, like intuitively, if you have very high frequency data, the price tends to move around. Like, for example, high frequency data might be moving around a lot. But if you aggregate, for example, to maybe yearly frequency, the up and down might be canceled out in the middle at the yearly frequency. So your return might be look like this, okay? So the higher the frequency, the noisier it is, and the more volatile it is most of the time. And the lower frequency means you cancel out some movements in the middle. Usually the return and the price are much smoother and the less noise it has. So, and if you use the daily data sometimes, if you use daily data, it's noisier, yes, but there is a good thing. There is some benefit. You have more data, because if you only use, like, if you use 1 year frequency, every year you only have one return. But within the year, there might be 250 trading days. Then you will have 250 data points for the return if you use daily data. So that's usually the case when people want to use higher frequency data, because you're gonna have much more data points. And according to statistics, the more data, the better. However, it is facing the noise or measurement error potentially. So it's always a trade-off, but people still want to use the higher frequency sometimes. And if you use the daily return, be careful with those low trading volume days, because there are some stocks that are not very popular, not like Google or Apple or Tesla. They are very popular stocks. There are some very small stocks that many does not have enough attention from investors. Sometimes, maybe for 1 day or several days, the stock price does not move because there is no one trading it. And again, the stock price that you use most of the time are the real transaction price. So it has to be traded between investors so that you can have a transaction price. If there's no transaction price or no transaction going on, usually in the data, you just observe the same price, not moving as before, as the most latest transaction price. But the price does not move doesn't mean the price does not move. You know what I mean? Like, if there's no trading, you observe the data does not move around, but the true price of the stock might be potentially moving if there is a transaction. So suppose counterfactually, there is a transaction, the price. This price, say, let's call it PT plus 1, it's very hard to equal the last price if there is demand and supply comes up. Or if you think about the value of the firm or of the stock, it's very dangerous to assume the value does not change at all over time. And the price does not move might be wrong simply because there's no trading. Then if you use this wrong price, your return gonna be biased, either up or down. So if you use the CAPM for the stocks with no trade days, say there are many days the price does not move because of no trading, then during the days, the stock return will be 0 all the time. Then your beta will be biased down because there should be some co-movements or covariance, but in real data, you don't observe. Okay, then your beta will be biased because of those many constant 0 data points. So if beta is biased, then you might underestimate the correlation between the stock and the market index. So the beta might be too low compared to the real beta that the stock has. So how to deal with that is a problem. It's still ongoing research in finance. Sometimes people need to use some special mechanisms or methodologies to fill in the missing data. We call it missing data, like the price is missed sometimes. And which way is better? There's no answer, and you have to make some assumptions to back out the right return sometimes to get the right beta. So be careful with like high frequency data, because usually the missing or the non-moving prices happens in the higher frequency. It's easier to have no trading for a day or 2 days than have no trading for a whole year. Most of the time within a year, you at least have some tradings going on and some transactions. And as a result, the lower frequency will be less noisy than the high frequency with many static prices or returns. Question?
No.
Okay. So I'm done with all the empirical details. There will be more if you really use the data and many concerns, but it's endless if we talk about everything. And let's move on. So just keep in mind so far, when you estimate the CAPM, there will be a lot of concerns underlying it because of dealing with real data. It's very hard and has a lot of details. Suppose now you get a perfect data and have everything considered and assumption well made. Let's move on to estimate the CAPM. The CAPM model looks like this, right? No, it actually looks like a expected return minus RF equals to equals to beta I. This is a CAPM model, but you cannot estimate a CAPM model using a statistical method unless you write it in a statistical way. This is the statistical formula we're gonna use. It's coming from the regression form. Usually regression assumes, say, y equals to a plus bx plus error. The y here is called a dependent variable. And the x here is called the independent variable. And a is usually called intercept. And b is usually called slope. And the error term is the noise, because in the data, you cannot have perfect y equals to a plus bx. Sometimes it's moving up and down nearby the line. Then the statistical formula has to allow to some degree the error or noise going on. Then applying this regression model to the CAPM, the Y independent variable will be the excess return of individual stock. And alpha will be the intercept. Beta is the slope, and also is the one we are the most interested in, the measure of individual risk level. X, or independent variable, is the market risk premium, or market excess return. And we still have an error term here. Usually in regression, we assume the expectation of error term equals to 0. It means that although sometimes you observe Y is above the line. So let me visualize it a little bit more. This is X, this is Y. The regression tells you this line. This part is A, and the slope of this line is B. You might, the dots are your data observations. So you might observe the dots, the data above or below the line. But on average, if you calculate, if you like sum together all of the arrows, these are the arrows, like this point and this point. If you sum all of those arrows and together, it should be 0 on average, meaning that on average, all the data are on the line. But for individual data, it might diverge from the regression line. And if you take the expectation on the two sides, the E expected error will be 0, so will disappear. And you're gonna have the left-hand side is the individual stock risk premium equals to the alpha plus beta times the market risk premium. And the error term has some economic meaning. So the error term is about the firm's specific news, for example, or like firm's individual idiosyncratic shock. You can think in this way. Like the line gives you the prediction, here the line gives you the prediction of the market systematic shock. And the fact that the individual points deviate from the prediction of market is caused by the stock individual noise or idiosyncratic shocks. And on average, we assume that the idiosyncratic shock should be 0. It's very similar to what we learned earlier, like idiosyncratic shocks does not really matter. Do you have any questions?
No, but I think you didn't upload the new version of the slides. So
oh yeah. I changed it like 30 minutes ago. I will upload this one later.
Okay.
Yeah. Did you learn regression before?
Yes, I did.
Okay. So is that included in the business statistics class?
It's very similar though.
Okay. Yeah. So CAPM, because it assumes linear regression between the individual stock return and the market. So it exactly fits in the regression formula. So people use regression. And how do you estimate alpha and beta in practice? Beta is something we want, but alpha, according to CAPM, it should not exist. If CAPM holds, alpha should not exist. Then this is related to the failure of CAPM in the real data that we discussed on Wednesday. In the real world, in the real data, many people tried different ways to test if the CAPM holds, and they find that alpha is statistically significant, meaning there is an alpha that is not captured by CAPM. In other words, CAPM is wrong because according to CAPM, alpha should not exist. But because we use a statistical model, we should include the intercept and the slope. So you're able to test if the intercept is 0 or not. Then you can first estimate what is alpha and beta and test if the alpha and the beta are 0 or are they positive. One way is to calculate the covariance and the variance like we do in Excel, like just using data, or like I asked you to do by hand using the calculator, but intrinsically the same. Another way is to use linear regression. As we talked earlier, as I just mentioned, it can deal with very big data, and it can also use to test if it's statistically 0 or not. Okay, and linear regression is most time done by Excel, and in research we use some other programming languages like Python or Stata or MATLAB. But in this class, we will just use Excel. So actually, this plot is not, it's kind of controversial. So you see the y-axis and x-axis are the expected return minus risk-free rate. But usually in the real world, in the real data, we do regret, we use the first formula, this one. So this one means you use the realized return rather than expected return on both sides. So sometimes if you plot out the returns, you plot the excess return or realized return versus, individual versus the market. But let's take it as if they are very similar or very close to each other. And after you plot it out, you'll see it's very similar to the dot that I just draw before, the pattern of the data. And you can see the individual stock is positively moving with the market return. And the goal is to fit a line using the regression method. So this line will have slope of beta. And here is alpha, is the intercept. And we call it security characteristic line. It's coming from the data. And again, here, the slope is giving you the market beta of this individual stock. Suppose you have two stocks. Here, the two stocks are very nice. They all have alpha equal to 0 because they crosses the origin. But you can see the slopes are very different. For stock 1, the beta I or the slope is much flatter than the slope of stock 2. So what it means is that the slope, the higher the slope, I think you should think about y equals to a plus bx. The higher the b, the steeper the line will be. So in this case, beta 2 is definitely bigger than beta 1. If you fit these two lines, then you can tell stock 2 has higher market risk than stock 1. Is that clear?
Yes.
And as I explained earlier, the alpha is just the intercept term. So if you find like the previous slide, if you find the line across the origin, it means alpha equals to 0. But if you have a positive intercept, it means alpha is greater than 0, sorry. And if the line has a negative intercept, it means alpha is negative. So still just a very simple idea. The alpha is, you can think of as if it's the intercept. Positive intercept means positive alpha, and negative intercept means negative alpha. So, but all of those are coming from like the data and the regression results. Then let's see an example here in the slide, and later on I will tell you an example about using the real Excel. Here, it's a time series plot of S&P 500 return, excess return, meaning it's minus risk-free rate, and the HMP excess return. So by plotting the time series, you can see how volatile the return is, or how volatile the stock is. But to estimate beta, we don't plot the time series because we want the x-axis to be S&P 500, not time, and the y-axis to be HP. So if you plot for the regression, you will plot like this: S&P 500 on the x-axis, HP on the y-axis, and here I already fit a line, the blue line. But if you look at the dots, right, the dots, they are the original observations of the return, and you can see roughly they are following this blue line pattern, but they are deviating from time to time. So for example, here, this is the arrow term, and here it's another arrow term. These are big arrows, and these are the small arrows. So the underlying assumption is this equation. So it's the original regression model that we are trying to use. The the excess return on HP can be decomposed into a intercept alpha and the beta times market excess return and the error term. We're gonna talk about how to fit this line in Excel. But when you fit the CAPM model in Excel using real data, you usually plot in this way. So by plotting the data points, you can see what is the relationship between the individual stock return versus the market or the S&P 500 stock return. And if you do the regression, it will give you some statistics. Some of them you can just ignore it, but some of them will be helpful. I will just cover the basic ones. If you are interested, you can dig more into what they mean. So R square is very important. R square is very similar to what we learned about the risk decomposition. In the risk decomposition part, we learned R square equals to beta I squared times what's that, covariance? Let me see. Yeah, here. Okay, so in the risk decomposition part, R squared equals to beta squared sigma M squared divided by the sigma I squared. As we talked in class, it's just the portion of the total risk that is accounted by the market risk. So meaning like how much can the market volatility explain the individual stock volatility. Here, the R square is, sorry, it's a little bit messy. Here, this R square is different, but it's kind of similar idea. You can think as if they are very intuitively very similar, although the formula does not, these are not equivalent mathematically, but intuitively they are very closely related. It just means how much the variation of the individual stock can be explained by the stock part, by the market part. So still, how much the stock volatility is coming from the market volatility. Intuitively, it's capturing the same thing. And here it says around 52% of the stock individual HP return variation is coming from the market. Okay. And another thing you want to know is the observation. This is very important in empirical research. So here you only have 60 data, which is quite small, because if you download all the data points from say Yahoo Finance, it will be much more than 60. Of course, it depends on if you use yearly return or you use monthly return or data or daily return. But the more observation, usually the better the estimate results, because you use more data and it is more trustworthy. ANOVA is another statistical term that helps you to test or to judge if the model is good or not. And it will have some special terms that I will not cover here. If you're interested, you can dig more into that. But idea is that to check if the model is right or if the model is good compared to if it is good fitting the data, if it's doing a good job to explain the data. Okay, and this part is the most important one. Coefficients. Intercept is basically equivalent to alpha. And the coefficient of S&P 500 is the slope or the beta. So using the data in the previous slide, we get an alpha equal to 0.0086 and a beta equals to 2.0348. Then I have a question. I have a question for you, Yuran. Do you think the alpha is good or not?
No.
Why?
Because the p-value is too big.
You're on the right track, but it's the other way around. Because it's too big, it means alpha is good. So p-value, just the conclusion is the lower the p-value, the more possible it is non-zero. Okay, the p-value is about the probability if alpha equals to 0. Usually, the higher the p-value, or not usually, the higher the p-value, the more likely alpha is equal to 0. Although you might not get absolute 0 here on the point estimate, but statistically it is saying it's very likely alpha is equal to 0. And usually we use a threshold of 5%. If the p-value is very low, for example, here, beta is really low, it's lower than 5%. Then we can say the beta is not 0. It's very far from 0. So the beta equals to, it's clear, like it's much higher than alpha, it's much further from 0. So the p-value is really low. But here, because p-value is around 40%, it's very high compared to the 5% threshold. So statistically, we cannot say alpha is non-zero, or statistically we can say it's very likely alpha equals to 0. Is that clear?
Yes.
So Very good. I was expecting something like, oh, the coefficient estimate is now 0, so it's not good. Actually, you're looking at p-value is really, really nice. It's on the right track. But usually it's very hard to get this point estimate to be absolute 0. It's really hard for data to do that perfect job. But if we observe the alpha is not statistically far from 0, then we are good. We can say this alpha is pretty good and the CAPM is working very well. Okay. Any questions?
But what about the beta?
Yeah, beta is around 2, which is okay. So for beta, we only know that beta equals to 0 means risk-free, and beta equals to 1 means market, like same as market level risk. So beta can be higher than 1 or lower than 1. That's okay, but it cannot be like so crazy, say 100. But what is the threshold for crazy? We don't know. And because the statistical test, this p-value is talking about if beta equals to 0 or not. So it's actually not very informative because we know most of the time beta should be around 1 rather than around 0.
Oh, so that means like is very much likely the p-value of beta is going to be 0.
So, okay, there are two things. The p-value here, this p-value, the p-value for beta is the probability if beta equals to 0. Okay, this is the meaning of the p-value. And because p-value is very, very low, it's almost 0. So this p-value is telling you it's unlikely beta equals to 0.
Because beta would be like around a 1 something.
Beta should be around 1 is the economic prediction from the model. But statistically here, the output from the regression is only testing if beta is around 0 and the result is null, because you can see here beta is 2 is very far from 0. But you can change for example, regression specifications to test the probability of beta equals to 1 or the probability of beta greater than 1. These two numbers are not output here. You can test it using another method or using some other specifications. But the only thing that is reported here is that beta is not 0. That's for sure.
Okay.
Okay, good. So beta equals to 2, which means here it is riskier than the market portfolio. That's the only thing you can know from this table. And you can do more if you have the ability or you need, but usually that's it. And we already interpreted. So alpha and t statistics related to p-values, you can just look p-values, and r-squares, again, I said, is the percentage of the variation that you can explain using the regression model. It's roughly the same, you talking about how much it is explained by the market portfolio. Okay, so it says around 53% of the stock variation is explained by the CAPM model. In other words, by the market portfolio. Because in the CAPM model, there is only market portfolio that is explaining everything. Okay, so another numerical example. Here, stock A, you can see we are using annual return now. Has returned in previous 10 years. Again, it's a very small data point, so it has only 10 data. The market throughout the year related. And then I collect the risk-free rate here, okay? And again, because when you want to estimate the CAPM, you want the excess return on stock A and the market. So you use RA, basically this column, minus risk-free rate, this column, to get this column. And for the market excess return, use the market column minus the risk-free rate. You get the market excess return. And you want to use the last two columns to estimate the CAPM model. This is the statistical output or Excel output. We're gonna do an example in Excel later. And you can see here the beta is 1.405, around 1.41, right? Slightly bigger than 1, it looks okay. And intercept is 0.02 around. Then let me ask you again, Yuran, is this alpha good or not?
No.
Why?
P-value is too small.
Exactly. So you can see here, the p-value is around 5%. It's slightly lower than 5%, meaning that it fails our threshold. Like it's only 5% probability that the intercept is 0. So it's not good because it's very unlikely according to our 5% threshold. So the p-value is too low. But nevertheless, we estimate the alpha, which is around 2.5%, and the beta around 1.4. And you can also do that rather than run regression. You can also do that using what we learned about the formula on beta. So just a recap, beta I equals to covariance between Ri and R market divided by sigma market squared, variance of market. So this variance is the estimation actually. So you can, in Excel, you can calculate the estimate of variance between the last two columns. And you get this number. And you can also estimate the variance on the last column. You can get this number. And you divide these two by each other. It's just plugging in the beta formula that I just write down here. You will get the same thing, 1.41 around. And you see this number is very close to the regression result. So it's just 2 ways to estimate the beta. Okay. Then if you use the numerical, if you use the second way to calculate the alpha, what will that calculate the beta, like plugging in the formula here, what will be the alpha? The alpha, because we have this formula that we talked at the beginning of this lecture. So alpha will equals to just move this whole thing to the left-hand side. You get expected excess return minus beta times expected market excess return. So alpha will be the expected risk, expected individual stock return, excess individual stock return minus beta times expected market excess return. Then what it means is that you are just using an average across time. So for example, here, you get beta, okay? It's for beta equals to 1.41. You can use beta to calculate another column. Let's call it RA minus RF minus beta times RM minus RF. So it's basically using this number, say minus 9.92% minus 1.41 times negative 7.93%. So you do this repeatedly. You do this for all the cells, and you can get this term, this column. This is actually your beta, but it's like, it's not your beta, it's actually your alpha. The first one will be alpha year 1, and then you get alpha year 2, all the way to alpha year 10. And for the final alpha, like the intercept of the regression, you take the average. The alpha is just the average from year 1 to year 10. So basically, it's just the intercept will be equal to the average of this column above. That's another way, like manually to calculate the intercepts and the beta. That's gonna be almost the same as the regression, but you do not have the, say, the p-value or the statistical test output. Is that clear?
Yes.
Okay, good. Then, because you can just do what I told you here as before, the average will be 2.48%. It's the same as the regression output. And that's it. That's it for the slides. Then I would like to go to the Excel if you don't have any questions.
No.
Good. So give me some second because I have to switch to my laptop, to my desktop.
Okay.
Great.
Can you hear me?
Yes.
Let me log out. Okay, so now let me focus on the Excel. Again, we're gonna cover the chapter 6 first and then chapter 7. So I have for chapter 6, I have some practice question for you. It's not practice question because it's not gonna be tested. Can you see the problem set 3?
Yes.
So this is a problem from the question from previous years because they did problem set, but we have quiz this semester. So, okay. So let's read it through. You are an equity analyst and your boss asks you to do some analysis to create a stock portfolio that you can sell to the clients and use the information in the Excel to calculate the things required. Let me show you the Excel. Can you see the Excel?
Yeah.
This is the data. So usually when you get the data from the say the data provider, Yahoo Finance, for example, it will have many information, and these are usually the ones most commonly used. So first of all, this whole portion is for JP Morgan, JPM, and this whole portion is for Chipotle. And we have the monthly data. You can see this is data on the price in January 2014. And this is the March 2014 and all the way to 2019. Okay. And another thing is it has 5 columns. Oh, no, sorry, 6 columns. The open is the open price. Open price is the first price on one trading day. For example, today is like Saturday, so it's not trading day. There's no price. But say for on Monday, if I remember correctly, it's gonna be 9 a.m. And the time that the market started trading, the first price will be recorded as open price. High price means within, okay, just to clarify, the open price is also, I mean, it's not for a day, it's for the trading period. So for example, here, the trading period is a monthly trading price. It's at monthly frequency. So the open price for this month, I mean, the open price is the first price for this month at the beginning of this month. What I just said, say for on Monday, like 9 a.m. is for daily trading. So if you download the daily data and you get the open price, it's the first price on that day. So it's like morning. And here is the first price of this month because it's monthly data. And the high is the highest price during this month, like say March. And low is the lowest price in this month. Close is the last price in this month because it's the ending, it's the close price. Adjusted close price usually is after adjusting for dividend. So if the stock pays dividend, the close price is not really the close price because the dividend has some value. So you need to adjust for the dividend to get a right close price. So this is the adjusted close price. And also a stock splits, for example. And volume is how much the stock is traded within the month. Okay, so it has the definitions here. And what we need to do are here. So because all the data are raw, are just the price data, but usually we focus on return. As we learned in the portfolio theory chapter, we use return to construct the portfolios. So how do you get the return? These are all the adjusted close price throughout the time. And the return is just the second one divided by the first one minus 1. So think as if this is the price at t plus 1, and this is the price at t. Same for here, the return is just the price next period return divided by previous period return minus 1. And you do the same thing for each row. You will get a time series of returns. This is the time series of return for JP Morgan. And this is the time period of return for Chipotle. So one thing you need to remember is that you do not use the raw close return. Okay, because the raw close return usually might be messy because of dividend and stock split. So dividend might be okay, but stock split is terrible. Like for example, Apple was traded at $100, and after split 1 to 2 by 2, then the Apple might be traded at 50, but it's actually not price decrease from 100 to 50. It's just a stock split. But if you use the raw close, like 50 divided by 100 and minus 1, it's gonna be negative 50%. It's not it's not reflecting the real value of your stock return. So split might be a problem. So that's why people always use the adjusted close, because it's the return that should be okay, it's the return that tease out, that exclude all of those unusual events like split or dividend. Okay. Any questions on getting the return?
No.
Okay. So after getting the return, there are many. I will now show you the PDF. It's basically all here. You can calculate the total return of JP Morgan. Total return means throughout the whole time period that is covered in this Excel. It means from the first month all the way to last month. So here you can see this cell is B62. This cell is D62. So the total return of JP Morgan is B62 divided by B3, the first price, minus 1. This is the total holding period return. And the total holding period return for Chipotle is just a D62 divided by D3, the first price, minus 1. Expected return, as I mentioned in class, usually in the data in the sample, when we say expected return, it means estimate of expected return or the historical expected return. This is just the average, using the average formula in Excel of this column, all the returns. And the same thing for Chipotle average. Okay. Standard deviation is just using the function standard deviation dot as means sample of this whole column. And Chipotle, exact same thing, same formula, just a different data input. And the variance gonna be the standard deviation squared. Same, standard deviation squared. And Sharpe ratio is the expected return minus the risk-free rate is given here, divided by the standard deviation, just following the formula that we covered in class. Sharpe ratio of Chipotle, same thing. Covariance, very simple, just to use the covariance dot as function and input these two return columns. Okay. And you can get covariance. It's pretty low actually. And the correlation between these two is the covariance divided by each standard deviation, as we covered in class. Any questions so far?
No.
So then it asks you to calculate the optimal risky portfolio weight. You can see this number. Why is it absolute number? So I guess from the previous year, they use the math to use a calculator to calculate this one. But basically it's following the gigantic formula in chapter 6. Let me show you. Yeah, so it basically follows this formula. And I assume you know that because this is it might be tested on quiz 3. So just plug in this formula in the Excel and it's gonna give you the number. So the optimal risky portfolio weight includes around 90% in JP Morgan and around 10% in Chipotle. And the portfolio return the risky one, I mean, the risky portfolio return will be just the weight in the JP Morgan times expected return on JP Morgan plus the weight in Tripoli times the expected return on Tripoli. And the portfolio variance follows the formula in chapter 6. It's just a weight in JP Morgan squared times the variance of JP Morgan plus the weight in Tripoli squared times the variance of Tripoli, and plus 2 times the weights and the covariance is also the same formula. Standard deviation is just the square root of the variance. And Sharpe ratio is the expected return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. Questions?
No.
And this part is showing you how to find the place on the optimal CAL, because in the original question, it gives you the risk aversion. So by having the risk aversion and the risk-free rate, you're able to find your location on the optimal CAL. Here, the weight in the risky portfolio will be following the formula we covered in class, expected return minus risk-free rate as the numerator. Denominator is the portfolio variance times risk aversion. It means on the optimal CAL, you invest this amount, like 1.4, around 1.4, 140% in risky portfolio. And as a result, in risk-free rate, you invest minus 40%, basically meaning you're borrowing at risk-free rate and invest more than 100 in the risky portfolio. Within the risky portfolio, you invest in JP Morgan and Tripoli. The weight in JP Morgan will be your total wealth is divided first between the risky portfolio and risk-free rate. And within the risky portfolio, you invest 90% around in JP Morgan. So this number tells how much of your total wealth is invested in JP Morgan. And this one tells you how much of your total wealth is in Tripoli. So in other words, these three numbers sum together to 1, meaning that you are borrowing for around 40% risk-free rate and invest around 120% in JP Morgan and around 13% into Tripoli. And the result is kind of, you can see you invest a lot in JP Morgan actually. It's intuitive because JP Morgan has much higher Sharpe ratio than Tripoli. Okay. Expected return on the complete portfolio is like complete portfolio means on the optimal CAL, if you have the risk-free rate, it's gonna be the weighted average between the portfolio return and the risk-free rate. So it's just the portion, the weight in the risky portfolio is 140%, 136% times the portfolio return around 1.3% plus minus 36% times the risk-free rate. Then you get your complete portfolio, meaning on the optimal CAL, your expected return is around 2%. And the standard deviation is just the portion in the risky portfolio times the portfolio standard deviation. This formula, again, is the first section in chapter 6, 1 risky asset, 1 risk-free asset. In that scenario, your portfolio standard deviation will be Y, the portion in your risky asset times the risky asset standard deviation. So Y here is 140%, 136% times the portfolio standard deviation around 5%. So you get around 7% standard deviation of your complete portfolio. Is that clear?
Yeah.
So in other words, this whole section here are very simple if you know the formula, if you are given the formula sheet, especially the covariance part. You don't need to do it by hand. You can just use the function in Excel. The key takeaway of this problem set is actually here. It's at the beginning of this part. You have to get to know how to get the returns. And sometimes people get it wrong. Again, you have to use the adjusted close price. Okay, adjusted close price to get the returns, the time series. Sometimes people use close divided by open to get the stock return. That's also okay in some scenarios. Some people do that. And you can see the open price, like the next period open price, although it's supposed to be same as the last month close price, but they are not exactly the same. So sometimes people use the open price to better capture the right open price, but they are very close to each other. So the reason why the last month close price is different from the next month open price is that there might be some off-market trading. So we as retail investors, we don't have access to that market, but some other players like institutions, they might trade after the market is closed. So the open price is not necessarily the same as the close price, but not super different most of the time, especially for big firms. The best way, to exclude all the dividend and stock split, you're supposed to use adjusted close, but usually we don't have the adjusted open. So people just assume that the end of last month close is the same as this month open. Then you can just use one column, adjusted close price, to get the return. And after you get the return, everything becomes very simple. You just plug in the numbers here. Okay. Now let's go to chapter 7, CAPM estimation. So although we covered the slides of chapter 7 at the beginning, but I didn't continue directly using chapter 7 CAPM, this Excel example, because I want to let you know how to calculate the return. Okay. So this is the raw data, adjusted close of Google and S&P 500, T-bills used to estimate risk-free rate. And again, it's monthly from 2017 all the way to 2021. First, we need to get the excess return. If you remember, we just covered in the slide. And before excess return, we need to get the return, the raw return. Google is just a adjusted close, as we did exactly the same in the previous example. And you get this column of Google returns. You get this column for S&P 500 returns. And you know the corresponding risk-free return in the period. Okay. Excess return is very simple. It's just the Google excess return is just the Google return minus risk-free return. It exactly follows our formula, R minus RF. S&P 500, also very simple, just S&P 500 return minus risk-free return. You get this two column. Okay. Then to estimate CAPM, you only use column H and column I. Let me show you the results first. This is the statistical output So you can see it looks very similar as the slides that we covered. And you can observe here the scatter plot. Let's look at the plot first, because this is not in the, it's a little bit different from the slide. On the y-axis is the S&P 500 excess return. X-axis is S&P 500 excess return. And the y-axis is the Google excess return. The blue dots are simply the plot, the scatter plot of this H and I columns. So these are the data observations. And the orange one, you can see here, is predicted Y, or predicted Google excess return. So it basically means rather than just ignore the Google excess return, you use the estimated alpha and estimated beta and plug in your CAPM model, you will get an absolute line. You can see here, these orange dots are just one line. So in other words, the orange line is the return predicted by the CAPM, which of course differs from the blue dots, the realized return. And the difference between the blue dot and the orange line is the error term that we covered it earlier. And you can see the blue dots tells you roughly there is a positively correlation between the Google return and S&P 500 return, although it differs sometimes. And you can see from the plot also, the intercept here does not look like zero. It looks like a little bit positive. And you can see from the intercept coefficient estimate is positive. But as we talked earlier, you have to just, judge it by the p-value rather than just the number. So you can see the p-value is above 5%. So statistically, it looks okay given the 5% threshold, but the p-value looks kind of also very small. It's 8%, it's basically very close to 5%. So it means statistically you can say, well, alpha might not be very far from zero, but it's also a little bit not super close. So statistics is like this. There's no absolute right or wrong. It's all about probability. So it's like there's 8 probability that the intercept is 0, but is the 8% probability high or low? It depends on your threshold. If your threshold is 5%, it looks okay. But if you use a 10% threshold, then it's too low. Then let's look at the results here. The beta is 1.07, 1.08, and it's kind of nearby 1. And here it plots the residual. What is the residual? It's just the E in our slide, error term. Basically, it's just in this slide, in this plot, it's using the blue dot minus the orange line. And in this plot, the second plot, the X variable is just the Google. And it plots all the residuals or all the error terms from the regression. And you can see it's, well, some above 0, some below 0, and overall it looks okay. Like the overall, on average, the residual should be 0. That's what is required by the regression model. And the dots are from here. So for each predicted Y, you have a corresponding observed Y or observed Google return. You can use that one to minus the predicted one, so you get all the residuals and all the error terms. Any questions about just the results?
No.
Okay, then let me quickly show you how to get everything here. In Excel, in the data section, you need a data analysis add-on. If your Excel does not have it, you have to add this in the data analysis. Click in the data analysis. There's an option called regression. And you can see already input it here. Keep in mind that, okay, I inputted reversely. Keep in mind that your Y range or Y variable is the individual stock. It's the dependent variable on the left-hand side. So you have to input all the numerical numbers. And the X range, X is the S&P 500. Just input all the numbers here. And this output option gives you you can output to a new worksheet, just a sheet. Or you can output to a completely new Excel, or you can output in the same sheet by choosing the output range. But let's use the new sheet. And you can also output the residuals and the line fitted output. So residuals are the residuals or the errors I just described to you. And the line fit is the orange line. Instead of plotting it, you can fit a line. And residual plots is the plot I showed you later on. Standardized residual is some advanced one. I will not cover it here. Okay. A normal probability is also some advanced. You can dig in by yourself. And that's it, basically. Just click OK. You can see here. Yeah, the label looks a little bit ugly. So you might want to change it. Just delete everything. Okay, this is the residual one. This is the X, Google, oh no, S&P 500. This is the residual plot that same as I showed you. And this plot is the fitted line. You can change like all of the things here and also change labels. I always input Google S&P 500. Okay, and here you can also change it. So, okay, I was wrong, like fitted line basically means the orange dots, the predicted one, the predicted Google excess return. And if you don't choose that option, you will not have this one, I guess. And you can change the titles here, right? That's it. It's very, very simple. Any questions?
No.
Okay, so that's all I have for today. And please send me an email or anything if you have any other questions. And I wish you have a good autumn break.
Thank you.